Good afternoon, everyone. I'm Dave Weisberger, CEO of CoinRoutes. It's time for our weekly This Week in Crypto roundup. It is Friday, May 12th. Well, last week I said I thought Bitcoin was going to decouple from the equity markets. And I guess as the half full, I would say I was right. Bitcoin is decoupled from the equity markets. Bitcoin and Ether are both down around 9% this week, while the equity markets more or less are flat. That isn't what I was expecting, but well, that's what happens. The fact of the matter is, in the global scheme of things, it's still more or less a wiggle. We're still not very far below the bottom of that trading range that I keep talking about. We're still well above the lows from the last bear market, or the bear market point earlier this year. And what we saw was something that's very interesting. So what's going on in the market? There are two or three factors that were leading here. Factor number one: weirdly, people are starting to believe that there will be a resolution to the debt ceiling that doesn't involve short-term money printing. Color me skeptical, but it's possible. And if so, then that means there's one less catalyst possible for Bitcoin and Ether to move higher. Second thing that's happening is we had the Pepe fiasco. We had yet another meme coin with $1 billion market cap being driven up of a picture of a freaking frog. Now, I'm not going to go off like my friend Scott Melker in terms of talking about the absolute ridiculousness of this in the middle of what's going on in the regulatory situation, where we had hearings in front of Congress where the entire Democratic Party in the administration was handed talking points to explain that crypto is too risky, is too volatile, is too untrustworthy, and is too hard to surveil for bad actors. Though that was their talking points. Whereas believe it or not, on the Republican side, it's all about economic freedom. And the reality of the situation is that what the Democrats were saying was mostly misrepresentations, some outright lies and fabrications, and some selective truths in the middle of the situation. The fact is, in the equity markets, we've seen lots of Pepes. They were in the internet bubble and other things. We've seen movies called Boiler Room about this stuff. Being a security is no panacea toward get rich quick schemes. People like to make money, but that's not really what's driving the market. What's driving the market is you had a catalyst in the name of a meme coin that people took money from more stable coins and had to go someplace else, not stable coins, but more the Bitcoins, the large caps. And that is enough selling to matter on the margin. At the same time, we had a couple of very big news stories. We had Jump and Jane Street both pulling liquidity out of the US market, which rattled people. We're going to talk about that liquidity in a second, because at CoinRoutes, we've done some really interesting research about this. And the simple answer to what's going on could best be summed up by one of my favorite books, The Hitchhiker's Guide to the Galaxy. And it's basically don't panic. And we'll talk about why in a second. But understanding the news stories for the week are important. The regulators getting more aggressive is a problem. So we have this incredible dichotomy, and what shouldn't be a bipartisan issue is shaping up to be a bipartisan issue. Now, the fact that almost all the people quoting the Democratic talking points were 75 years old or older is making this a generational issue, and it's the kind of thing that is really unhealthy. But let's talk about what's actually happening. So on the positive side this week is a story that a lot of people haven't talked about, but I think is huge. The Chamber of Commerce, not the Digital Chamber of Commerce, who of course is going to support Coinbase, but the US Chamber of Commerce wrote an amicus brief to the court defending Coinbase's suit against the SEC, talking about how the SEC is probably violating the law in the way they're doing regulation by enforcement and not giving clarity. That is a big deal. Now, are they mostly Republican? I suppose they lean that way, but they tend to be pretty centrist. So when an organization like that gets there, it's important. And people need to understand that in the long run, that's what's going to matter. I also sat at a conference yesterday, actually, in New York City by the AIMA, which is a traditional financial group on alternative assets. It was fully on digital assets for the day. It was oversubscribed. They had 50 people deep in their waiting list that couldn't get into the conference. This is markedly in contrast to previous bear market cycles. In previous bear market cycles, the people in TradFi ran away from crypto as fast as they could. The reality is they're not running away. In fact, everybody is just gnashing their teeth at waiting for potentially 2 years and God forbid, 6 years for this administration to not be in charge of economic policy. But the companies that are working in the private sector are all really interested for a very simple reason. The financial markets of the future will be more resembling digital asset market structure than what we currently have. The future is digital. And whether or not it's about Pepe coins or Dog coin or Shiba Inu coin, probably not. But Bitcoin and Ether are highly likely to be part of any future financial system. So that's what's going on there. The other big story that is definitely putting a cap on Bitcoin is the gas fees in Bitcoin. The use of BRC20 tokens, the so-called inscribing BTC ordinals, is causing congestion in the networks. It's very reminiscent, actually, of 2018 crypto kitties screwing over Ethereum. But the truth is, it does matter because one of the uses of Bitcoin has been micropayments. People from Venezuela, Argentina, Turkey, etc., sending small amounts of Bitcoin. You can't send $10 worth of Bitcoin when it costs $40 to do a transaction. So that doesn't work. You could certainly send millions. That is very, very economical, but you can't send small payments. Now, small payments on USDT Tether, that does make sense. And Tether, for all the bashing over the years, just reported not just fully collateralized, but excess collateral and a $1.25 billion profit in the first quarter. Tether is going nowhere. Now, why am I focusing on Tether? Well, importantly, CoinRoutes did some research recently, and we started looking at the cost of trading. Now, the next chart shows you for Bitcoin dollar, the cost of trading from $25,000 to $1 million. And you see in March, there was a huge dip in that chart, meaning that costs actually went negative. What that represents is backwardizations, is one exchange bidding higher than the other exchanges are offering. And that happened because people couldn't move money from one exchange to another when Signet went down. Toward the end of the month, that started to normalize. What you saw in April was when Jump and Jane Street and other market makers pulled out is a similar dip, half the size. But to put this in order of magnitude, instead of a 3x in cost, it doubled in cost. And still, even though it's normalizing a bit, the costs are still 50% higher than they used to be. And the way we calculate that cost is by looking at the cost of trading a million versus the 25,000. So that's our CoinRoutes liquidity metric, and that's the second chart that you can see. When you look at those costs, understand that it looks like a market that is difficult. Yet, if you look at CoinRoutes customer transaction cost analysis, we see something very interesting. We have never had a better month. Why? Because our system knows when prices are out of sync and can use that signal to get better liquidity. We also can allow people to get liquidity using Bitcoin Tether and other products in our multi-product feature. So we've delivered better performance. In fact, we outperformed our own cost calculator by 17 basis points on almost $1 billion of simple Bitcoin dollar transactions last month. That's pretty huge. That savings goes directly to the bottom line of our clients. That's the third chart. Now, what is also going on here is look at Bitcoin Tether. When you look at that chart, and that's the next one that you're seeing, the Bitcoin Tether chart shows almost no change in April. Yes, there was a dip in March because that affected the entire market. But in April, all the overseas market makers, they didn't change anything. In fact, costs are flat. So the market structure for Bitcoin writ large is actually quite healthy. But people who focus only on myopic things like Bitcoin dollar in certain exchanges are seeing a very different picture than CoinRoutes sees. That's important because when the Congress people start talking about markets, they have absolutely no idea of what's going on. All this data is representative of a market that is healing itself pretty quickly, a market that is actually working. Sure. Are there issues with leverage? Are there issues with liquidation? Yes, we've talked about them many times. Would it be better if there were a self-regulatory organization in crypto instead of, tribal fighting among the firms? Yes, of course. And in fact, that's the direction it needs to go. Are things like MiCA in Europe and what the FCA is planning and what they're doing in a variety of other jurisdictions from Dubai to Hong Kong going to get us to a more regulated market? Absolutely. Is the US likely to fall behind in this scenario? Sadly, yes, unless the political climate changes. And that's something that we always monitor. I'm tired of talking about it on this cast, but I will continue to do so. But the data is extremely important here because when you go back and look at those charts that we just showed you, or you could go on blogs.coinroutes.com and read about it, you can see incredibly clear proof that the regulatory difficulties in the US are directly hurting US focused investors and not hurting the rest of the world. Think about what I just said. The US is already falling behind. Jobs are leaving our shores. To put this in a final bit of perspective, I would estimate that US capital markets primacy has been worth millions of jobs to our economy and worth trillions of dollars in GDP over the last 2 decades. We are at risk of losing that if the world goes digital for all assets and we fall behind because of internecine political warfare. Consider that this weekend. Hopefully you can enjoy it. The sun is shining here. The sun is shining in New York. Everyone have a great time out there and stay safe.